Hey there, Tom Hicks, CPA here with J.T. Hicks Company, tax advisors and consultants. And today I'm talking to you about what it means to be tax ready if you are a business, okay? So the number one reason why I have to reject tax information provided by businesses or their tax return is delayed is really due to a lack of consistently accurate information. Now, most of you, if you own a business, you pretty much know you have to have a bookkeeping system. You really can't show up at my office or any tax professional's office with a cardboard box or a plastic grocery bag from your local supermarket and then just dump all those receipts onto your tax professional's desk, right? Doesn't work that way. If you tried to do that, I would send you away and tell you to go find somebody else, or I would tell you that I'm going to have to wait till after April 15th to do this, and it's going to cost you a boatload of money if you want me to be the one to sort all this stuff out. So it's way better and way cheaper if you adopt some type of bookkeeping system. The one that most people commonly identify with is QuickBooks, but there are lots of other bookkeeping systems that are available for your PC, your laptop, and so on. So anyway, there's a lot of things that you can do to make sure that you submit complete and accurate information to your tax professional so that he or she can prepare a complete and accurate income tax return for you. So what I've done is I've created some fictitious financial statements, which are for a florist type business. And we're going to talk about each of the items that are on these statements and why it's important and what kinds of things you need to provide to your tax professional so that he or she can prepare your corporate partnership, whatever, Schedule C, Schedule E, Schedule F, whatever it is, so that they can prepare a complete and accurate return for you. So I'm going to go ahead and share my screen here, and we'll talk about the financial statements, each one as they are listed here. So the name of our business is the Blossom Street Florist. And the Blossom Street Florist has, like every other business, there are two basic financial statements that we want to see. One is the balance sheet. The other is the statement of income and expenses, or income statement, or profit and loss, as you've maybe heard about it. Just basically, a balance sheet is like a snapshot or a Polaroid for those of you that remember what that is. And it takes a picture of the assets, liabilities, and equity of your business at a specific date. Now, typically, this is on December 31st, the last day of the year. And so every balance sheet has assets, it has liabilities, and it has owner's equity. Okay. Now, all your assets are things like cash, accounts receivable, inventory, equipment that you use in your business, et cetera. Liabilities typically are what we call trade accounts payable, maybe amounts that you owe to other vendors, businesses in your area that you maybe get goods and services from. If you have any bank loans or other financing types of arrangements, these are typically referred to as notes payable. Okay, so typically you're going to have an account for each loan that you have. Maybe it's a credit card. Maybe you have a loan that you use to, say, buy the business that was guaranteed through the SBA, and maybe it's your local bank that has loaned you money. You're going to have an account on your balance sheet for that liability, for the credit card, for the delivery van loan that you took to be able to deliver flowers. So that's all going to be there. And basically, owner's equity is really everything that's left over. All of your assets minus your liabilities is what your equity in the business really is. So let's jump ahead and let's look at a income statement. Now, an income statement is nothing more. This is more like a movie. Okay, you know how you use that in the charades. This is more like a movie, and it covers a specific period in time, such as January 1st through December 31st of any given year. And so it has information in it, like all of your revenue, all the flowers that you sold, okay, what it cost you to buy those flowers, the rent on your shop, wages, utilities, depreciation, all the expenses related to operating your business, because all of this information, in fact, for both statements, all of it's really critical because it's going to go somewhere on an income tax return. So we've really got to have this information. So now I'm going to show you something that's, it's going to be in all of your accounting software, whichever one that you're using. Forgive me, seem to be having a little technical difficulty. There we go. Okay, so I want to introduce you to something called a trial balance. Okay, and this is something that your tax professional uses very much in the process of creating your tax reports. And you'll see the trial balance really shows us all of the accounts, all the assets, all the liabilities, all the revenue, and all the expenses, etc. And it totals that, and you see your debits are always equal to your credits. So we know that we've got a good listing here of all your assets, liabilities, equity, revenue, and expenses. Okay. Now, some things that you should do to be ready, right? Number one is please reconcile your checking account with the bank. Now, your QuickBooks program will help you through this process. The number one reason that I kick back, information back to the client is because you haven't reconciled your checking accounts and your credit card accounts. And I can tell any tax professional that's looking at your books using QuickBooks or some other program, we can tell whether you've gone through the reconciliation process. I realize you hate this. It's not pleasant, but QuickBooks makes it really, really easy. The reason that this is important is when you've reconciled your account with the bank, then we have more than reasonable assurance that all of the transactions that pass through your bank account, meaning deposits and checks, all of that, it's all been captured in your bookkeeping system. Now, it might not be in the right places, in the right accounts, but we know it's all there. Okay, so that's the number one reason that I will kick back projects back to clients, is because they haven't reconciled their accounts, whether it's a checking account or a credit card account. And programs like QuickBooks make it really easy to do that. So there's really no excuse for not doing it. Because sometimes I see some crazy stuff. Like I'll see a negative cash amount here. Instead of having $25,000 in the bank, if I saw a minus sign in front of that number, that would tell me that you were overdrawn, that you wrote more checks than you had money for. And we couldn't believe why the bank wouldn't cash those, right? It would bounce those checks. So I almost immediately always know that there's a problem if I see a negative number there. But again, the number one thing you can do, make sure your accounts are reconciled for all the months, January through December. Make sure you do that. It's never been easier to do it in QuickBooks. And if you don't do it, then I'm probably going to push your project off to the side of the road, out of traffic, and it's going to have to get looked at after April 15th. And I know you don't want that to happen, and your tax professional doesn't want that to happen either. Okay. So, when it comes to if you have customers that owe you money, take a look at your reports. There's something called an aging report in your bookkeeping system that'll show you who owes you money and how long it's been outstanding. Oftentimes we find lots and lots and lots of mistakes here, and anything that is not really outstanding is affecting the other numbers, right? It's affecting your revenue. It's affecting other things like your assets, et cetera, on your balance sheet. So have a look at that aging report. If your business has inventory, then you need to be doing an inventory count on December 31st or thereabouts, and count all of the items, all the widgets, all the whatever it is you sell. And you have to really look up in your purchase records, when was the last time I bought this item? What did I pay for it? And multiply the two, give us a list and tell us this is what I had in stock on December 31st when I turned out the lights on New Year's Eve and I decided to go home and get ready to go out for a party. This is what I had in the shop at that time. That's going to be actually pretty important. All right. So let me tell you about the number two thing that you don't see on this report. And if you did, it would be right over here. Okay. And this is an account number. Okay. And it's not a very good pound sign. Sorry about that. But the number two reason I will kick back a project to a client is because you don't have account numbers assigned to each of your ledger accounts. Now, the account number is critically important to your tax professional. That gives them a bunch of information. But more importantly, that account number acts as a unique identifier to that account. And most of us have software that we're going to be able to go into QuickBooks. We're going to be able to extract information out of QuickBooks, move it into our software so that we can adjust it and make changes and move things around. But our software can't accept that data if there's no account number. And if there isn't an account number and I have to do it manually, then you can imagine, like, why would you call a taxi cab to come to your home and take you to the airport for a flight when you haven't even started packing yet? Doesn't make any sense at all to have a taxi meter sitting in your driveway with the meter running. Makes no sense. So, it's easy to assign account numbers. Now, the account number also tells your tax professional and their software what kind of account it is. So if an account is numbered 1,000 to 1,999, it knows that that's an asset. If it sees 2,000 to 2,999, it knows it's a liability. In the same schema in 3,000, it knows it's equity. 4,000, it knows it's revenue. 5,000, it knows it's cost of sales. And 6,000 and higher, it knows that those are various types of expenses. So again, number one, number two is that you haven't reconciled your checking accounts and your credit card accounts. And number two, your general ledger accounts don't have numbers. Okay. So, having said all of that, it becomes critically important to look at these reports and because it does tell you, it gives you information, right? So again, I'm going to go back up and we're going to go back to the balance sheet just to have a quick look there. So now I've already talked about you really got to have reconciliations. Please look at your account receivable reports. Make sure they're accurate before you give it to us. If you have inventory, do an inventory account and evaluation. We're going to need that information. If you have, this is really critically important right here. Okay, if you have bank loans that are financing some equipment that you have, either it's that delivery truck I talked about, maybe it's machinery and equipment inside your shop, maybe it's the loan that you use to buy this, the business, or maybe the building that it's in. Your lender is going to annually produce a statement. You might have to log on to your account on their website. Sometimes it comes in the mail, but your tax professional really needs that statement because it's going to do two things. It's going to confirm the balance that you owe as of December 31st, and we're going to use that statement to check the accuracy of the number that's on your balance sheet. If it doesn't agree, we're going to go and investigate. Why doesn't it agree? 9 times out of 10, it's because of interest. It's the way you've recorded your monthly payment. So that document gives us the balance and it gives us the interest. So it makes it easy for us to adjust that balance and claim the correct amount of interest for that loan on your tax return. So other things that are really critically important, again, just back it up a second. Make sure you have those statements for every single loan, no matter how big or small it is. Every lender produces these statements. It's easy to log on, print it off, make sure you give it, to your tax preparer. Things that happen down, in owner's equity, when you have withdrawn money from your business for your own personal use, paying your personal mortgage, buying groceries at your local grocery store, gas, all that sort of stuff, do make sure that you correctly identify those disbursements and that they get their own account down here in the equity section because we want to make sure that we capture all those transactions and they don't get mixed into operating expenses. Whenever you extract money from your business, it is not an operating expense, okay? It is you merely extracting profit from your business for your own personal needs, all of which is completely legit and legal to do, but do just make sure that, you make sure that those disbursements are going into an account that identifies them as distributions and it's part of owner's equity. So let's move over to the income statement again. Now, most cases, if you are selling a product, a product that requires, say, sales tax to be collected, we really want your December filing, which is always done in January of the following year. There's a report that you're filing every month to turn over the sales tax you've collected to your state. We want that statement from December that you filed in January. And the reason that we want that is we want to check the liability account on your balance sheet for sales tax to make sure that it is accurate. Other things that we're going to be looking for, if you are paying rent, we might have to issue a 1099 miscellaneous document to your landlord, assuming that you're renting. And so the income statement is going to have to reflect the correct number of payments for the correct amount because we're going to want to file this document with the Internal Revenue Service on your behalf. And we, of course, want it to be accurate. It costs you money if it's not accurate, and we have to go back and we have to correct it. Okay, so that costs you more money when you do that. If you have employees, okay, please, I'm hoping that you have a payroll service. We happen to offer a payroll service in our office. It's through Paychex Corporation. It's fantastic. It's one fixed monthly cost, no matter how many employees you have or how many payrolls you run. But we are absolutely going to need the last payroll register of the year for the last pay date of the year. And that register should include all active and terminated employees for the entire year. The reason that we need that is we're going to make sure that we're claiming the correct amount of gross wages as a deduction on your corporate income tax return. We're also going to make sure that we are deducting the correct amount of employer share of taxes. And that payroll register for the last payroll of the year, all inclusive, is going to be the fastest, most effective way for us to get those correct numbers. Okay. So, the depreciation expense, you don't have to worry about too much, but because that's something that we calculate. But I often find that you all are trying to be conscientious, and you buy a stapler and you look at the stapler and you say, "Oh, that's going to last more than a year, so I'm going to code that over into property and equipment," and it's a $39 stapler. Come on, folks. We're not going to depreciate a $39 stapler. That belongs in office supplies. Then oftentimes I see that you put something in the supplies expense. So you don't really have to worry too much about depreciation expense, as I was saying. But when you buy a $5,000 copy machine, please don't put that in supplies expense. That belongs over in property and equipment. The same way, if you buy a $39 stapler, please don't put that in property and equipment. That belongs over in office supplies expense, et cetera. So just to recap, you really have to have a bookkeeping system. The one that we like the most is QuickBooks, but there are others like FreshBooks, Xero, et cetera, that you could use for your system. Please don't show up with a cardboard box or a grocery bag from your local supermarket. That isn't going to work for any tax professional, especially on any date between January and April 15th. It's just not going to work. So be proactive about this. Keep up your bookkeeping, throughout the year. When you are getting ready, you want to be tax ready. You want to take a look at these financial statements, make sure that these reports reflect accurately what happened in your business throughout the year. Please do make sure that you reconcile all your checking and credit card accounts. Check your accounts receivable reports to make sure that they're accurate. Do an inventory at the end of the year, okay? Make sure that you give us statements from your lenders which show the balance of the loan on the last day of the tax year and the interest that you paid. Please do make sure you have a separate account in your equity section for monies that you withdraw from the company. Okay. Number two, looking at your income statement, give us your sales tax report, please, because that's going to help us establish the balance of any sales tax that's still due at the end of the year or was due at the end of the year. Look at your rent expense, and definitely we need that report from your payroll company so that we can accurately put those numbers together in your in your tax return. And then when we look at your accounts overall, please, please, please have account numbers assigned to each of your accounts. This is the number one and number two reason that we kick stuff back, is because it just adds more work, right? If I have to input this data for every single account that you have, and you could have hundreds, right? That taxi cab meter is running, okay? You don't want to pay those kind of fees. I don't want to charge them. Nobody does, because there's 2 or 3 dozen people standing behind you that all have their tax information ready, and they are tax ready, and you can do that project, get done and get paid. And meanwhile, you're standing in the way because you are not tax ready for your business. So please do do those basic things, and it will be a lot easier on you. It'll be a lot easier on your tax professional at the end of the year to be able to do those tax returns for you. So once again, if you would like to know more about how to be tax efficient for you and your business, please feel free to contact me. You can find me on the web at jthicksandcompany.com. If you'd like to self-schedule a appointment, you can do so through our website. Look for the Contact Us button and follow the prompts, and you'll be able to get quickly schedule a meeting that's convenient for you, for us to talk about whatever your tax concerns are. And once again, just reminding you all that a good tax advisor is not expensive. He or she is priceless. So once again, Tom Hicks, CPA for J.T. Hicks & Company. Until next time, please, please be tax efficient.